It's well known that the cost of buying a home or doing business with a farm loan is high. But how long could high interest rates last? Here's John Phipps.
Mortgage interest rates, residential, just hit a 20-year high, topping 7%. This is faintly amusing to some of us, as my first home had a 7% interest rate thanks to the VA, and we celebrated what a bargain it was. Coupled with the rising cost of housing, mortgage rates have placed home ownership out of the reach for many Americans. It also has another effect, what I call mortgage bonding. During the still unbelievable run this century of interest rates as low as 2-something, those long-term mortgages are a powerful inducement to not move or get a new mortgage. For farmers, many of whom are looking at sub 4% long-term land financing, the real interest rate when inflation is subtracted is 0 or negative. High borrowing costs will slowly dampen farmer demand for acres, as record land prices mean all but a few will have to borrow some to buy. Buying out siblings in an estate settlement has suddenly become a little more challenging. Similarly, speeding up the payoff of a mortgage to get out of debt makes a little less sense if that extra cash could be safely invested at far more than your old mortgage rate. Interest rates will slow the turnover rate for real estate, but eventually some of us will have to bite that mortgage bullet. The question becomes, how long can high rates, or relatively high rates, last? Maybe history can help. This graph from Kevin Drum shows the duration of rate increases by the Fed of more than 3 points. Now, the 9 years of the 80s, that's grim, but I think the oil price spike was probably unique. The other rate increases seem to suggest they last about 3 to 4 years. Since rates began going up in March of 22, a reasonable guess would be late 25 at the earliest to return to previous rates. The problem with this historical approach is rate increases were previously forced back down by a faltering economy, which is not the case today. GDP growth, unemployment, and consumer spending are not shouting recession's on the way, just the opposite. Our economy is robust. My guess is to watch the housing market because it may be the most sensitive sector to interest rates, and buyers can only stall so long. Another indicator will be employee quits, as workers are essentially frozen into that earlier 4% mortgage, and it could take a whopping raise or much lower interest rates to get them to move. Above all, we should look at this graph and marvel at an unprecedented era of cheap borrowing.
Thanks, John. Well, a tractor dating back to World War II. Machinery Pete, he has Tractor Tales next.